The US dollar experienced a decline against the euro on Tuesday, influenced by a modest increase in consumer prices in July that kept the door open for a possible interest rate cut by the Federal Reserve next month. This slice of economic data suggests that the Fed might pause or even ease its monetary policy, especially if inflation remains subdued. But here's where it gets controversial. Some experts argue that this cautious approach could backfire, potentially fueling economic instability or undermining the dollar's global standing. Let's break down what happened. The Consumer Price Index, CPI, which measures the average change over time in the prices paid by consumers, went up by just 0.2% last month. This follows a 0.3% rise in June, according to the Labour Department's Bureau of Labour Statistics report released Tuesday. Over the 12 months ending in July, the CPI increased by 2.7%, matching June's annual growth rate. Economists surveyed by Reuters had anticipated a similar 0.2% monthly rise and a 2.8% year-over-year increase. What does this mean? Basically, inflation remains relatively tame, giving policymakers some wiggle room to consider lowering interest rates. Carl Schmotter, chief market strategist at Corpay, pointed out that underlying inflation, the core trend excluding volatile food and energy prices, continues to stay muted. He suggests that this could stand in the way of aggressive rate hikes, allowing the Fed to keep options open. Looking ahead, Schmotter believes Federal Reserve Chair Jerome Powell might announce a potential rate cut during his speech at the Jackson Hole Economic Symposium later this month. Investors and traders had been cautiously optimistic that the latest inflation figures would reinforce the market's expectation for a rate reduction next month, especially after weak payroll data last week had already raised such prospects. On the currency front, the euro recovered from earlier losses, climbing slightly to trade at roughly 1.16235. Meanwhile, the US dollar pared some of its gains against the Japanese yen, trading marginally higher at 148.39 yen. As Schmotter explained, narrowing yield spreads between US and other major economies are putting sustained downward pressure on the dollar, something that could persist if incoming economic data signals a slowdown in the US economy. But here's the part most people miss. Predicting currency movements amid ongoing global uncertainties, especially tariffs and trade tensions, remains incredibly complicated. The influence of tariffs and geopolitical shifts on dollar strength isn't always straightforward, making the dollar's future path more uncertain than current numbers suggest. Adding a dash of political intrigue, former Federal Reserve Bank of St. Louis President James Bullard threw his hat into the ring, saying he would accept a Fed chair position if offered, emphasizing the importance of protecting the dollar's value and maintaining low, stable inflation, while respecting the independence of the Fed. His comments underline ongoing debates about leadership direction at the central bank and how it can impact markets. On the currency markets outside the US, sterling gained 0.4% against the dollar, reaching around $1.3485, buoyed by slightly better Britain's jobs data. Although employment growth slowed, wage increases remained elevated, reinforcing the Bank of England's cautious stance on interest rate adjustments. The BOE recently cut rates in a narrow vote, hinting that any future changes will be carefully calibrated. Meanwhile, the Australian dollar dipped 0.3% to about 0.64945 after the Reserve Bank of Australia announced a rate cut, citing easing inflation and a softer job market. Still, experts suggest a likely follow-up rate cut in November isn't out of the question, with rates possibly remaining at 3.35% for an extended period. Lastly, the markets largely ignored new tariffs imposed by the US on Chinese imports, which were extended for another 90 days as expected. Cryptocurrencies like Bitcoin remained relatively steady, hovering around $119,395 after climbing earlier in the week, close to July's all-time high of around $123,153. All in all, while the economic indicators are signaling a potential pause or easing in US monetary policy, the global picture remains complex. Uncertainty around tariffs, geopolitical developments, and varying economic signals keep investors guessing about the dollar's future trajectory. Are we on the cusp of a new currency cycle? Or is this just another temporary wobble? That's a debate worth having.